Did you know that over 70% of millionaires have built their wealth through passive income streams like index funds? If you're tired of living paycheck to paycheck or feeling overwhelmed by complicated investment options, there's a simple, proven way to start earning money while you sleep. Index funds offer a low-effort, high-potential solution to grow your wealth without the stress of picking stocks or timing the market. Whether you're a complete beginner or looking to diversify your investments, this method can change your financial future faster than you think. And the best part? It's easier than you might imagine. So, if you're serious about creating a steady stream of passive income, make sure to hit that like button and subscribe. This could be the game changer you've been searching for. Now, let me show you why this is so urgent and what you need to know before getting started. Welcome. Today, we're exploring the easiest way to generate passive income using index funds. If you're new to investing or seeking a simple, effective strategy to grow your wealth, this is for you. We'll break down how investing in index funds can provide steady, reliable income without the complexity of picking individual stocks or trying to beat the market. Right now, in the current U.S. economic climate, the landscape is uncertain but full of opportunity. With inflation concerns, fluctuating markets, and low interest rates, building a stable passive income stream has never been more important. Index funds offer a low-cost, diversified solution that can help you weather economic ups and downs while steadily increasing your wealth over time. Whether you're a beginner trying to get started or someone looking to diversify your investments, this guide will give you clear, actionable insights. By the end, you'll understand how index funds work, why they're a smart choice for passive income, and how you can begin integrating them into your financial plan today. Our goal is to empower you with the knowledge to make smarter investment decisions, even if you're just starting out. But to make smart decisions, you first need to understand the economic landscape we're dealing with. In today's economic landscape, understanding the environment is crucial before diving into passive income strategies. Currently, the U.S. economy faces a complex mix of challenges and opportunities. According to the Federal Reserve, inflation remains elevated at around 4% annually, well above their 2% target, which erodes purchasing power and impact savings. The Bureau of Labor Statistics reports that real wages have stagnated, making it harder for many Americans to keep pace with rising costs. Interest rates are also a key factor. The Fed has increased rates multiple times over the past year to combat inflation, pushing the federal funds rate to around 5%. Higher rates mean higher borrowing costs and often increased returns on savings and fixed income investments. However, this also cools down the housing market. The National Association of Realtors notes that home sales have declined by approximately 20% compared to last year, affecting wealth accumulation through real estate. Market cycles are more volatile than ever, with stock markets experiencing swings driven by geopolitical tensions, inflation fears, and economic data. While these fluctuations can seem daunting, they also create opportunities, especially for long-term investors focusing on passive income. Tax policies remain relatively stable, but changes at the legislative level could influence investment returns and capital gains. All these factors highlight the importance of a resilient, diversified approach to building passive income streams. Index funds, with their broad market exposure and low costs, stand out as a practical solution in this uncertain environment. With that context in mind, let's break down the strategy you can actually apply. Making passive income with index funds is one of the simplest and most effective ways to grow your wealth over time. The idea is straightforward. Instead of trying to pick individual stocks or time the market, you invest in a broad collection of stocks that track the overall market, called an index. First, you choose an index fund, which is a type of investment that holds many different stocks, mirroring the performance of a specific market index like the S&P 500. You buy shares of this fund through a brokerage account, just like purchasing a stock. Once you hold these shares, you become a part owner of all the companies in that index. The key to earning passive income from this setup is through dividends and the appreciation of the fund's value over time. Dividends are regular payments companies make to shareholders, and when you invest in index funds, you receive a portion of these payments. Additionally, as the overall market grows, the value of your shares tends to increase, boosting your investment's worth. This process is passive because, after your initial investment, you don't need to actively manage or select individual stocks. You can choose to reinvest dividends automatically, which helps your money grow faster, or take the payments as income. Overall, investing in index funds is a low-cost, low-maintenance way to build a reliable stream of passive income, especially useful in uncertain economic times. Now let's look at a real-world example to see exactly how this plays out in practice. Imagine you decide to invest $10,000 in a broad U.S. index fund, like an S&P 500 ETF. Historically, the S&P 500 has returned about 7% annually after inflation. If you reinvest dividends, your investment could grow steadily over time. Let's break down the numbers. With a 7% annual return, your $10,000 could grow to approximately $10,700 after 1 year. That's an increase of $700. Over 5 years, assuming consistent returns and reinvestment, your investment might grow to around $14,000. This means you're earning passive income simply by holding the fund, as dividends are paid out regularly, often quarterly, and can be reinvested or taken as cash. Now, if you set up a plan to withdraw only the dividends, which typically amount to 2 to 3% annually, you could generate around $200 to $300 per year in passive income from your initial $10,000 investment. As your investment grows over time, so does your income. For example, after 10 years, your portfolio could be worth roughly $19,700, providing an annual dividend income of around $400 to $600, depending on dividend yields. To visualize, use tools like Zillow or MortgageCalculator.org to compare this passive income to monthly expenses, say, rent or mortgage payments, and see how your investment can support your lifestyle. This looks great, but only if you avoid the common traps that ruin deals like this. The easiest way to make passive income with index funds is a powerful strategy, but many investors stumble by making simple mistakes that can derail their success. Let's go over some common pitfalls and how to avoid them. First, jumping in without proper research. Too often, beginners buy into a fund without understanding its composition or fee structure, which can eat into your returns over time. Always take the time to review the fund's prospectus and historical performance. Second, try to time the market. It's tempting to buy low and sell high, but timing the market is risky and often leads to missed opportunities. Instead, focus on consistent, long-term investing. Dollar-cost averaging helps smooth out fluctuations. Third, neglecting to reinvest dividends. Many forget that reinvesting dividends accelerates growth and boosts your passive income faster. A simple setting in your broker account can automate this process. Fourth, ignoring the importance of diversification. Relying on a single index fund can expose you to unnecessary risk. Spreading investments across multiple funds or sectors reduces volatility and enhances stability. Lastly, panic selling during downturns. Market dips are normal, and reacting emotionally can lock in losses. Staying the course and maintaining your investment plan is key to building wealth over time. To avoid those mistakes, here are the best tools and resources available right now. The easiest way to generate passive income with index funds is by investing consistently and smartly. To do this effectively, you'll need some reliable platforms that make investing accessible and straightforward. First is Vanguard at Vanguard.com, known for its low-cost index funds and ETFs, making it a top choice for long-term investors. Next is Fidelity, available at Fidelity.com, which offers a wide range of index funds with no minimum investments and user-friendly tools. Third is Charles Schwab at Schwab.com, providing commission-free ETFs and educational resources that help you understand your investments better. Additionally, M1 Finance at M1Finance.com allows automatic investing and portfolio management, making it easy to stay consistent without constant oversight. Lastly, Robinhood at Robinhood.com offers commission-free trading and fractional shares, perfect for beginners who want to start small and learn as they grow. These platforms support your strategy by offering low fees, educational resources, and automation tools, helping you invest regularly without stress. They make it simple to set up automatic contributions, reinvest dividends, and diversify your holdings. Key steps toward building passive income over time. Now that you've got the tools, let's talk about the first thing you could do today to get started. Choose one of these platforms, open an account, and set up automatic contributions to your chosen index funds. Starting small, with consistent investments, is the most effective way to grow your passive income steadily over time. The easiest way to start building passive income with index funds begins with a simple step you can do today. It might be checking your credit score, downloading a user-friendly investing app, listing your monthly expenses, or even simulating an investment. Just pick one of these small actions. Why does this matter? Because taking that first step unlocks your momentum. It clears the path and makes the process feel less overwhelming. When you check your credit, you gain insight into your financial health, which helps you plan better. Downloading an app brings the world of investing right to your fingertips, making it accessible and easy to manage. Listing expenses reveals areas where you can save, creating more room to invest. Simulating an investment gives you a taste of how your money can grow over time, boosting your confidence. Starting small keeps your goals realistic and sustainable. Every journey begins with that initial move, and each step builds your confidence and knowledge. As you stay consistent, your small actions compound, leading to steady growth, passive income, and financial freedom. Remember, taking that first step is how every long-term success story begins. Let's look ahead. When you stay committed and keep moving forward, your investments will grow, your income will become more passive, and your future will become brighter. The key is to start today. Small steps today lead to big achievements tomorrow. Imagine yourself 5 years from now, having consistently invested a little each month into index funds. Maybe you've built a modest portfolio that steadily grows, providing you with some extra income and peace of mind. Now, fast forward 10 years. That small, regular contribution has compounded, turning into a significant nest egg. Perhaps you've even started to see passive income flow from dividends, giving you more financial freedom to enjoy your life. Now picture 30 years from now. Your disciplined, consistent investing has created a substantial wealth reserve. You might own multiple assets, possibly 5 or more cash-flowing properties or a diversified portfolio of index funds that generate reliable passive income. This steady growth isn't about overnight riches, but about the power of time and persistence. The magic of compound interest means your investments have been working for you, growing quietly but effectively. The key takeaway is that the simple act of starting and maintaining a consistent habit can lead to incredible long-term results. You don't need to be a market expert or invest large sums today. Just take that first step and stay committed. Over the years, this disciplined approach can transform your financial future, giving you the freedom to live on your terms. And now that you see what's possible, here's how we wrap this up and take action. Begin today, no matter how small, and let time do its work. Your future self will thank you. The easiest way to build passive income with index funds is to start small, stay consistent, and let the power of compound interest do the work over time. Remember, even tiny contributions made regularly can grow into a solid stream of income, whether through dividends or appreciation, without needing market expertise or big upfront investments. The key is to get started today, automate your contributions, and be patient as your portfolio grows year after year. Thanks for watching and celebrating your progress toward financial freedom. If you found this helpful, please hit that like button, subscribe for more tips, and comment below. What's your first financial goal for this year? For more on investing smartly, check out our video on top mistakes to avoid when investing in stocks. Stay confident, stay consistent, and I'll see you in the next one.